Good morning to everyone again. This is the third of 3 sessions. Those of you that made it all the way through, well done. This is EIS Advanced Issues and a special Christmas edition, hence the jumper. I think everyone on the call has been on before, but just in case not, I'm Neil Norman. I'm a senior tax partner in Chiene Tait. With me on the call is Nicola Williams. She's a senior tax manager and an EIS specialist. As I said, today is advanced issues under EIS. The last week was, to be fair, pretty advanced too, but believe it or not, it gets more complex. So without further ado, we're going to crack on. As before, there is a Q&A box. You are free to ask questions as you wish. There will also be time at the end. I'm going to try and share my screen. Nick, can you see my screen?
Not yet, no. No. Now I can. Good.
Apparently, it helps to press share when you're sharing your screen. That's good for next time. Right. Over to you, Nick.
Okay, so the first thing to say is that the age of the company requirement didn't always exist for EIS. Historically, there was no age limit. And then in 2015, along with a whole raft of other changes, an age limit was brought in. And I think the idea was to focus the EIS relief more narrowly on a particular set of companies, and in particular on startups. So the initial age limit that was brought in was 7 years. So if a company hadn't received any EIS investment within 7 years of its first commercial sale, then it wouldn't qualify for EIS. And then a little bit later on, another rule was brought in.
Seem to have lost Nick, so I'm just going to pick up where she was.
This was one of the first instances we see in the EIS legislation, and Neil will talk about this later, where knowledge-intensive companies were given special treatment. So whereas a regular company only had 7 years from its first sale to get its EIS, first round of EIS in, a knowledge-intensive company was given 10 years, and it can choose whether it's 10 years from its first commercial sale or whether it wants to go for 10 years from when it first exceeded 200,000. But it's a pretty easy choice, right? Why wouldn't you go for 10 years from when the company had first exceeded 200,000? It's going to give you a longer period to get that first EIS money in. And then once the company has already had its first EIS money in, then it's fine, and the company can take further follow-on rounds, further follow-on EIS monies. Sorry, I think there may be a technical issue. Neil, can you hear me?
What's the issue?
Yeah, okay.
Nick, what's the issue?
Sorry, I think my Wi-Fi froze there for a minute. Can you hear me now?
Yeah.
Okay, great. Sorry, I'll carry on. It looked like it was frozen on my screen. Okay, so as we said, 7 years or 10 years, depending on which type of company you're looking at. And then once the company has taken its first EIS investment, it can then take follow-on rounds. So as Neil's put, there's a few more conditions on that slide there. You have to show that the second fundraise is being used for the same trade as the first fundraise was. And if that's the case, and you've had a pass round of SEIS or EIS or SITR, then you're fine and you can carry on with further rounds, notwithstanding that the company might then be more than 7 years old or more than 10 years old. And next slide now. Okay, so condition B, this is where the company hasn't met the initial age requirement of the 7 or 10 years. It didn't take EIS within that first period, but what it wants to do is take funds for the first time, even though it's an older company. And in order to do that, what it has to show is that it's entering into either a new product market or a new geographic market. So the sort of rationale behind that is that effectively, if the company is doing one of those two things, then it is should be treated as a new company, because in effect it's competing with new companies who are doing those same sorts of things. There's another condition there, which is that the amount of the raise, which is being used for those purposes of the new market or the new product, it has to be at least 50% of the average turnover for the last 5 years is going to be raised through EIS.
On that second point, I've seen more than once a company raising money through LINC members, thinking that all they needed to do was get to be raising at least 50% of the average turnover for the last 5 years. Those last couple of words are important, through EIS. So if it's at least 50%, but you've got, for example, Scottish Investment Bank money, or you've got non-qualifying money, you're not going to hit the 50%. Just be careful for that. I'll take on from here. So knowledge-intensive companies. Nick alluded to knowledge-intensive companies and their relevance to the age of company requirement. But they have other purposes too. Now, to be a knowledge-intensive company, you have to get through 2 tests. The first test, almost always on the companies that we look at, who are your investee companies, it's met, which is the R&D test, which is at least 10% of operating costs in each of the last 3 years, or at least 15% of operating costs in one of the last 3 years was spent on R&D. We are actively looking at a case right now where the company thought operating costs meant costs that are on the P&L, profit and loss account, beneath the gross profit line. So you have sales less cost of sales equals gross profit. Then you have all your other costs. And they thought it was that part there. It is not. It is all costs of the company. But as I say, for the kind of high growth businesses that LINC members invest in, it's almost always met. That's the first test. The second test, again, you need to pass one of the 2, but they're completely unrelated. The skilled employees condition, otherwise known as the people test, is that at least 20% of all staff must require, not must have, must require to have a master's degree or higher to undertake their role. So, I've seen scenarios where someone's told me, that's fine, I've got a master's degree in HR. And I say, but did you need that master's degree in HR to undertake your role as the chief operating officer? And are you undertaking R&D? No, fine, then you don't qualify. And that's what it is. So at least 20% of all staff must require to have a master's degree or higher, and they must be directly engaged in R&D or IP generation. So if you think about, let's say, life science companies, classic in a lab, everyone's in a white coat, probably most have got higher than a master's degree, they'll have PhDs, they'll be postdocs. Well, in that case, actually, probably 100% of their staff will meet the condition, and that's fine. And that's the kind of companies that test is pointing at. But it's the kind of company where we're already through there and we're looking at sales and marketing activity, and that's where the money's being spent. It's a good chance they won't need that. The second condition is generally easier to get through, which is the innovation condition, which is that there must have been IP created. Well, yes, otherwise you wouldn't have got through the R&D test. And that you're expecting to generate at least 50% of revenue over the next 10 years from the exploitation of that IP. Now, the exploitation of the R&D of the IP could be in any method. It could be license fees, it could be royalties, it could be sales. But basically, you've created something and you're going to spend the next 10 years, or at least half your revenue over the next 10 years expected to be generated from it. Now, that last point may need to evidence the IP. The revenues guidance on this is detailed, and it shows all the things that they would look for as evidence for IP. I stress, we've stuck in about, I don't know, 30, 40 maybe knowledge-intensive companies, known as KICs, cases through advanced assurance. We've never once yet been asked to evidence the IP generation. I think that the revenue basically withhold the right to ask for evidence of the IP generation, but in practice they tend not to. I think they look at the nature of the company and go, well, it's bound to be generating IP, that's fine. The relevance of the KIC status, well, Nick's already alluded to the age of company requirement. It's a massive, massive perk for the age of company requirement to be a KIC. Blows open the window from 7 years to 10 years from the end of the accounting period. And the end of the accounting period might well be 5, 6 years in. So you could be looking at a company that's been trading for 16 years, still qualifying, not 7. The final point on the slide is around investment limits. When KICs were introduced, they blew open the investment limits. It's £12 million for a normal company across its life under EIS. And that's less risk finance investments. That's less SEIS, less various grants. It's £20 million if you're a KIC. And there's a £5 million annual limit for most companies. It's £10 million if you're a KIC. It's not 10 million times 4, it's 10 million times 2. I've never yet seen a company needing to take £10 million invested in by a LINC Scotland member. I have seen them invested in by EIS funds in London. It does happen. Now, the middle point there, which I left to last, is more subjective. The first and third points are just a question of fact. This middle one, in our experience, I think HMRC are more inclined to support KICs than other companies on contentious or subjective points. I've definitely had discussions with inspectors before where I've been told off the record, well, this isn't the kind of company that we would look to challenge. Interesting, helpful to know. And that's it for KICs. So now we move on to a completely unrelated subject, some time for something completely different. Receipt of value. Now, receipt of value, this comes up probably once a week through our help desk. The premise, I'm calling it ROV from here on in, the premise is this is a set of anti-avoidance rules that are designed to stop investors from receiving benefits from the company they're investing in. So imagine a scenario where a company asks an investor to put in 10 grand, and the investor comes back and goes, tell you what we'll do, instead of me giving you 10, I'll give you 20. And then you'll give me 10 back, but I'll claim tax relief on 20, and I'll get 6 grand, not 3 grand of income tax relief. Fundamentally wrong on every level. But that's the premise of what these rules are trying to stop. Insignificant benefits are ignored. Now, insignificant is not defined. It's kind of pointed to insignificant in terms of the investment, or less than £1,000. So if a company gives a benefit to an investor, it's less than £1,000, you're going to be fine, except for the but I'm about to tell you. But it could be more than £1,000 if that's insignificant in relation to their investment. The but is if that benefit was preordained, if it was agreed before the investment that the investor will receive X, Y, Z from the company, there is no de minimis, there is no insignificant rule. And so for that, where the revenue look is the investment agreement. Common receipts. Now, I mentioned last week and the week before, all EIS legislations in the Income Tax Act 2007. For those that are interested, this is section 216. There are about a dozen, something like that, explicit receipts of value. And to be clear, receipts of value are where the individual receives a disqualification, not where the company is disqualified. You can have a perfectly qualified company, but with disqualified individuals. These are the most common ones that we see. The first one is to repay, repurchase, or redeem shares or securities in the company. You have shares or securities and the company buys them back. That's a receipt of value, fair enough. Second one, repay debt owed to the investor. Now I'm going to come on to that, so I'm just going to sort of blast over that for now. I will come on to that in some detail. Third one, very, very common indeed. Extinguish a debt owed by the investor to someone. Most commonly on investment agreements, it will say the company will pay the legal fees or the transaction fees or the tax fees of the investors. That means the investor has a contract with their lawyer, with their accountant, with their tax advisor. They have a legal obligation, they have a debt, and the company pays it for them. That is a receipt of value. Now, in case most of you are sitting there going, oh, every single investment we do has that in. Yes, almost certainly every single investment you do has that in. But often it's not the investor, it's the syndicate that has the legal obligation. The syndicate has the contract with the lawyer. The syndicate has the contract with the accountant. Now, the syndicate's a company. Well, it's not the individual's responsibility, and therefore it's not their debt. But if you're an individual investor, if you invest alongside other people, and your lawyer says, we'll get the other side to pay your fees, that's fine, but you will receive a partial disqualification on your EIS. An example of that coming up. And last thing, transfer of assets to the investor. Now, overpayment of fees is very common. I've seen this so many times, and it's curiously always the same number. So if I invest £10,000, I'm a consultant in the business. I can get paid fees. Yeah. What if I was to invest £20,000 and instead get double my rate of fees for the first year? So, well, then you're caught by the receipt of value, and so you should be. But not shares. Now, this point comes up quite a lot. I've seen scenarios where individuals receive shares from the company, and you think instinctively that should be a receipt of value, but actually, the revenues position, or at least it was for the last couple of times I looked at it, and I haven't looked at it for a couple of years, was that shares are not assets of the company. Therefore, the company can't be granting a receipt of value with it. Someone's just asked a question. Would a director's loan cause disqualification of EIS in any situation? Graham, yes, it would. And I'll come on to why, I think in the next slide. Nope, I won't. I'll cover it now. So, if a loan has been made by a director to a company, and the loan is made after the investment, and when we're talking loans here, we're talking about debt as opposed to securities, and it's a very important distinction, which I will definitely go on to in my next section. And a debt, the revenue thing, is where the company goes, help, we need money, we can't make payroll, and the individual, often a director, goes, fine, have 10 grand, make payroll. If that debt post-dates an investment, if the investor is invested first, makes the debt second, and then gets repaid the debt, because let's say the company's taken the 10 grand, it's made payroll, then various receipts come in, and it gives the 10 grand back to the director, that is fine, that is allowed. But if the debt predates the investment, if the debt goes in first, and an investment is second, and that could be that they've had an investment first, then a debt, and then another investment. If the debt predates the investment, and then is repaid pursuant to the grant of new shares, often by a conversion, or I'll give you the money back and then we subscribe for shares, that's a disqualification. Now I've got an example on the fees point here. And my example investors are Mr. F. Fast and Miss L. Loose, Fast and Loose. They make £500,000 a US investment each into You'll Be Lucky Limited. The investors instruct T and C, a lesser known firm of accountants, to provide tax advice at a cost of £5,000 each. The investment agreement shows that the company will pay Fast and Loose's professional fees, and a receipt of value event does occur. Despite it only being 1% of the investment, 5 grand is well above the 1,000 de minimis, but it's still insignificant relative to the £500,000 investment. But because it was in the investment agreement, they are caught. Therefore, 1% of their investments will not qualify. And that means they don't get income tax relief on it, but it means they also will pay tax on that 1% when they sell the shares. This point is related. It's the next section in the legislation, but it does come up quite a lot. Repayments of share capital. The premise of this particular legislation is to stop a situation where Nick and I are both, or rather, I'm a shareholder in a company. Nick wants to buy my shares. I want to sell her my shares. But Nick wants EIS. And if she buys my shares, she doesn't get EIS because they're not new shares. So we convolute. We agree with the company that I will have my shares bought back. The company will buy my shares. Nick will invest in the company. The company's a wash, that's fine. And Nick gets EIS relief on the investment. That's what the rules are there to stop. And you know what? Fair enough. But they're a lot more severe than that. So if a company repurchases anyone's shares, anyone, during the 3-year EIS qualifying period of whichever investors, and the person doesn't suffer the loss of EIS relief because their shares have been bought back, in other words, they were not an EIS investor, then anyone, every single EIS investor who has live, when I say live, I mean in that 3-year EIS window, live EIS investment suffers a receipt of value event, and it's split across them. Excuse the small writing, I hope you can see it on your screens. But let's say 5 investors put 10, 20, 30, 40, 50 grand in each. And the company buys back an individual shares, not one of theirs, someone else's shares for 50 grand. And it doesn't have to all need to happen at the same time to be caught. It happens any time during that 3-year window. Each of the investors suffers a receipt of value event. Investor 1 put in 10 of the 150 grand that was invested, times the 50 grand that was paid to the individual is 3.33k. That's their receipt of value. Now, you take that 3.33, you divide it by 10, because that was their investment, and you multiply it by 3k, because that's the income tax relief they got on the 10. And £1,000, because it's 1/3 of the 3k they got, is repayable to HMRC, and the equivalent number of shares, 1/3 of their shares, are disqualified for disposal. And you can see further down the page how it works across all the individuals. So investor 1 loses 1,000, investor 2, 2, 3, 3, 4, 4, 5, 5. Add that up, that's £15,000. £15,000 is exactly 30% of £50,000, which was the amount paid to the individual. And that is the rate of relief. So you've got to watch for this. This comes up really quite often, and it comes up most often where an individual works for a company, they're leaving the company, their shares have to be bought back because that's what the articles say. They're a good leaver and they're entitled to get money for their shares. This is where this kicks in. If they're a bad leaver and they get nothing for their shares, don't worry about it. Convertible loan notes. I'm going to breathe and take a quick drink. Now, I've galloped through that last section. I want to spend a little bit more time on this. Convertible loan notes were absolutely on vogue in about 2010 to 2014 in the Scottish investment scene. It was the modus operandi of the Scottish investment scene to invest in shares through EIS and then top up using convertible loan notes. There was never any question they were getting EIS investment in the convertible loan notes, but that was what was done for short-term emergency investments. And coming back to the point I said before, oh, I've got another question. I'm going to interrupt what I was saying to go to this question because it makes sense to do it at this point. I've actually got 2 come through. The first one, is the clawback provision example just gone through a good reason for employees to have a different class of shares to EIS investors? Does it help? No, it doesn't. If the company buys any class of shares back, it's still caught. Whilst I say the premise of the legislation is to stop the Nick and me colluding together to do a deal scenario, it doesn't actually make any difference. The legislation talks about the repurchase of any shares, so a different class of shares doesn't help. Mr. Castell, how is HMRC's stance on share buybacks as a receipt of value consistent with this provision on, sorry, I'm laughing because of Ed's response. How is HMRC's stance on share buybacks as a receipt of value consistent with the position on an EIS investor receiving shares in lieu of fees where it's not a receipt of value? It isn't. It's a nonsense, I think. An EIS investor receiving shares in lieu of fees is and always was, to my mind, an asset in the company. But the revenue state's not an asset within the company, so it's not within the rules. I just don't understand. I don't understand why that's not a receipt of value. And their stance on share buybacks as a receipt of value, I think this is a classic case of a sledgehammer to crack a nut. It's not designed to catch the scenarios that it does. It's designed to stop Nick and I colluding. It's not designed to stop the company undertaking a perfectly commercial action, which is to buy back shares from someone leaving the business who is caught by terms of the articles. It's just not. Okay, so unless there are any more questions on that, I'll move on to the convertible loan notes. As I said, they were on vogue, and they were treated as debt for the purposes of, my goodness, I'm getting technical here, Section 2162B. I said the entire list of receipt of value events is in section 216. It's actually section 2162, and then it's A to K, something like that. B talks about debt. So coming back to the question I was asked before about directors' loans, the issuing company repays in pursuance of any arrangements for in connection with the acquisition of shares in respect of which EIS has claimed the debt owed to the investor. As I said, if you have a debt first, an investment second, and it repays as part of the investment round, or as any arrangements linked to the investment round, it's a receipt of value. That was their position. That is the position. That's exactly what the wording says for 2162B. But their position was the convertible loan notes were debt. And there was a case in 2009, Optos PLC, a company well known for having been invested in by Archangel investors many, many times. There was a case in 2009 where the taxpayers lost, which looked at 4 different things. One of them was convertible loan notes. And argument was put forward by the barrister for the taxpayers that a conversion of a loan note is not the repayment, repurchase, or redemption. It was rejected by the court. The court said, no, it's not. It's the simultaneous redemption, repurchase of the instrument and subscription for shares. So that takes away the conversion argument. And then it was established, and the Revenue's guidance actually still states on their own website that it was established by the case the convertible loan notes were a debt. This was in 2009. So that's the background. Convertible loan notes they were never going to qualify for EIS, but they were treated as a debt. The relevance of which is as long as they were not repaid in pursuant with arrangements for connection of shares, you were okay. Another question. Francis, does this apply only in Scotland? No, it does not. This is UK rules. These rules, this particular point, is something on which we are particularly hot because we stumbled across the issue with HMRC I'm about to go through. This is UK-wide rules, and frankly, lots of people just don't know it. Oh, seem to have scrolled in by mistake. This is their current position, and those that were around in 2014 will realise that this lit the blue touch paper, is that the expression? In 2014, we had a case, convertible loan note, and I phoned an inspector just for a pleasant chat, just to confirm my understanding that the conversion of the loan note was a debt. To be told, no, it's a security. I said, I'm sorry, it's a security. I said, well, where's that in your guidance? It's not in our guidance, it's our position, it's a security. And it kicked off a raft of back and forth between us and HMRC. This is why we happen to know this stuff so well. And it went quite high up in HMRC, and we went back and we went forth. Now, a security is not defined in EIS legislation. It is defined in a whole bunch of other tax legislation where it would be crystal clear that a loan note is a security and not a debt. But the Revenue determined, and I found off the record in a discussion I had with somebody, that actually they determined in 2012, they just never told anyone. I stress in 2009, it was found to be a debt. In 2012, they decided it is a security. The relevance is that takes you out of 2162B and into 2162A. The issuing company repays, redeems, or repurchases any of its share capital or securities which belong to the investor, or makes a payment to the investor for giving up the investor's right, blah, 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 blah. So under 2162B, to be caught, you need to have the debt before you invest. It needs to be a link to the exercise of the debt, the repurchase of the debt, or the redemption of the debt, linked to an investment. Otherwise, you're probably okay. 2162A is much wider. There is no time frame. There is no pursuant to. There is nothing of the sort. Thus, if you have a convertible loan note or a loan note or any other security, and the revenue told me they consider a security to be any written down debt whatsoever. So in the scenario where the director just gives the money, that's a debt. If the director said, I want a loan note, I want a loan agreement, and show me a lawyer that doesn't demand a loan agreement, right? I want a loan agreement, the revenue would say that turns it into security. This is a massive, massive, massive change in the revenue's interpretation of the legislation. As I say, we found it in 2014, they decided it was happening in 2012. I asked again in 15, I asked again in 16, I asked again in 17, and was told our position is the same. I haven't asked since. So, debt and EIS really just don't work together. Convertible loan notes don't work with EIS, because if you redeem them, repurchase them, repay them at any time during the EIS window, or during the next EIS window, or the next EIS window, if the investor makes several investments, the revenue will link it to that. That is their stated position, at least stated to us. Nick, were you going to jump in?
No, not especially. I was just going to say that all of this sounds like a lot of information on convertible loan notes, but the key takeaway is what you said, that having a convertible loan note in place itself isn't the problem.
Yeah.
It's only if you go and try to have it repaid to yourself during the term where you're still holding your EIS shares during that 3-year holding period. Yeah,
you're absolutely right, and it's a key point. And the point we always make when we're being asked about debt is the provision of the debt, the lending, is absolutely fine. The revenue, you have no issue with that at all. Curiously, the last point on this slide is also fine, as long as the interest is at market rate. It's not a receipt of value event. Now, listen to the words, receipt of value. To my mind, receiving interest on something you've lent to the company is more value, the more the receipt of value than actually getting your money back if you get pound for pound. But nevertheless, that's the position they're in. Final thoughts on convertible loan notes. Remember 164A? I talked about this 2 weeks ago. And I mentioned it again last week. 164A is the independent investor requirement, or the existing shareholding requirement. And it's, if anyone has shares already in a company and wish to subscribe for further shares and be EIS qualifying, then all of their existing shares must have been through EIS. So if someone has a loan note and they convert, and now they're a shareholder, they won't be able to invest again. ASAs, which I did talk about at length last week, are a much safer alternative. They do not carry the benefits of debt, however. They do not put you further up the queue. They do not pay a coupon. But they are a much safer alternative for an emergency investment into a company. And actually, that's part of the reason ASAs are so popular. And my last rather glib comment is just don't use loan notes if you can avoid it. Or if you do wish to use loan notes, do so fully aware of the consequences if those loan notes are reviewed. Now, when we went through this, and I went backwards and forwards with a number of syndicates asking a load of questions, because this was a massive change. It was pointed out that actually, in some cases, it is worth doing. It is worth doing, and accepting that, if you think a company's not that far away from being sold anyway, any EIS investment would be disqualified on the same. Potentially, it is the right instrument. And often a company, when it gets near the end and the investors are just a bit tired of it, of constantly backing with more and more investment, it's either going to succeed or fail quickly. So then potentially having a convertible loan note puts you further up the queue, and that's critical. Anyway, enough from me. Nick.
Okay, so control and independence condition. This is what we spoke about a little bit last week. There's rules around what sort of group the company can have. In terms of control, the company itself, it can't be controlled by another company. So one to watch out for is if there's a fund, for example, investing in the company, and the ultimate person behind that fund is a corporate partner, then that can accidentally cause the control requirement to be breached, because HMRC will look through all the fund structures and say, oh, hang on, there's a corporate up the top there. And if that corporate has more than 51%, then that can cause the control and independence test to be breached for the EIS company. And I think the next slide, Neil.
Is there control?
So also be aware that even if you are not under the control of another company, then if there's any arrangements in place by which the EIS company could become so controlled at any point in time, then that would also disqualify for EIS. So, you know, say you have an option in place with a corporate and that corporate has the right to buy the EIS company or a significant stake in it, then that would be a breach of the EIS company being independent, because it would be seen as subject to an arrangement by which it could come under the control of another corporate.
Just picking up on that point, about, I don't know, 5-6 years ago, something like that, I was asked by a LINC member to reach out to HMRC, which we did, in respect of one of their investee companies. And the investee company was taking an investment from a large corporate, and the large corporate wanted the right of first refusal in the event that someone came in to buy the company, and they were then to be offered up the same terms and have the right to make an offer for, not even the right to acquire, the right to make an offer for, which the shareholders were allowed to reject. And that was held to be, by HMRC, an arrangement by which the company could become under the control of another company. So it was that tenuous, a right to make an offer that could then be accepted, and therefore the company come under the control of. I'm not sure I agree with that. I'm not sure that a court would agree with that, but it's still useful for you all as investors to understand that, because it's very, very common indeed for a corporate to want some kind of right of refusal, because when they're making a 20% investment, often what they're doing is dipping their toe ahead of buying the business. Anything else on this, Nick, or should we move on?
No, I think the next slide is about subsidiaries, isn't it?
No.
Oh, no, okay. Okay, so risk to capital. Well, all I was going to say about subsidiaries is the point we made last week, that you know, if you're going to get into anything that looks like a joint venture, and it could put you in a position where you are perhaps controlling a company that doesn't have, that you don't have 51% ownership in, then be very careful with that, because the counter of the rule that the EIS company can't be under the control of another company is that it isn't allowed to control any other company which isn't a full 51% subsidiary of it. So joint ventures are very risky, so just stay away from those if at all possible.
Okay.
Right. And now the big one, risk to capital. And I know Neil is not a fan of these rules at all, so he'll probably have quite a lot to say on them and how subjective he feels they are, and that they give a lot of discretion to HMRC. And that is true in one respect, but where HMRC was coming from on this is the same place it was coming from when it introduced the age requirement that I started off this talk with, to say that, okay, we want to focus more narrowly on certain types of companies. They should be ideally young startup companies or companies going into new product markets, and there should be real risk there for the investors, because if the company is an established company and it's got its own assets behind it, it's you know, it should be able to go and find finance in the market. So HMRC was wanting to limit EIS to companies where they can't get finance easily in the market, and there's real risk there for the investors because of that, because of the companies being young and in a, you know, not very well commercially established position. So HMRC introduced a couple of tests, and one of them was this grow and develop test that came around first. That even came around before the risk to capital condition came around, and they put a piece into the legislation that said the EIS funds have to be used to develop and grow the business. So that was in there first, and you had to show that that was the purpose for which you'd issued the shares, was to raise funds in order to grow and develop the business. But it wasn't very specific. And then the risk to capital rules were introduced in 2018. And they gave more specificity on what develop and grow means. And they put some indicators into the legislation, which Neil has very handily put on the slide there. So they said, these are the sorts of things we mean when we say that you have to show the company is going to develop and grow over the long term. They said, we want to see increase in the number of employees that you are hiring, increase in customer base. So you have to aim to grow your customers, not just be satisfied with the same one contract, for example. You have to be shown to be able to have aims to increase your revenues or your turnover. And what HMRC really wants to see is that the company is there to be growing across the long term, to create jobs and all that sort of good stuff. So what HMRC doesn't want to see, the counter of that, is an SPV, which for anyone coming across the term for the first time, SPV is special purpose vehicle. So HMRC doesn't like where a company sets up an SPV just to do one contract or one specific piece of work, and then the intention is to wind that up and return those profits to the investors. Because that's the opposite of the long-term growth and development it wants to see. So if you come across anything with SPVs in it, be very careful. It's not to say they can't ever be used, but if you are going to use them, you need to be able to show to HMRC in your advance assurance that the intention is to use it for something which is part of the larger business, and then to return any funds that are generated, any profit, back to help the growth of the rest of the business or the rest of the group, not just to wind it up and give the money back to the shareholders at the end of the day. Similarly, if you're looking at investment memoranda or pitch decks, or whatever you want to call them, if there's anything in there that talks about an exit within the next few years, just be wary of that again, because that would be counter to what HMRC wants to see about long-term growth and development. It's not to say there can't be a general intention to exit at some point, but if it's written into your IM or into your pitch deck that, you know, there'll definitely be an exit in the next 2 years, and that's something HMRC is going to pick up on and say, well, that's going to make you fail the risk to capital, the develop and grow bit of that test. Because there is another bit to the risk to capital test, which we spoke about as well before when I said that there has to be a risk to the investors. So as well as looking at develop and grow, HMRC says, okay, show us that there's a real risk that this company will fail and the investors will lose their money. So if you're looking at a pre-revenue company, obviously that's quite likely because the company hasn't established itself or its products in the market, and it may never do so. So again, what HMRC wants to see there is that there's no guaranteed contracts, there's no sort of guaranteed income streams that would mean the company's just doing a specified task in a group and it's got no ambitions to grow, and the growth could take it either way. It may fail, it may do well. What this is really aimed at is things that didn't really happen too much in the Scottish market, but happened more down in the London market, where a lot of companies were set up purely to get EIS relief, and they were set up by what you might call avoidance structures by those who devised them just for the investors. There wasn't really any entrepreneurs involved in these structures. And so HMRC brought in this legislation really to counter what was going on in the London market there, not so much what was happening in Scotland at all. And so that is the reason the legislation seems a bit wide and a bit nebulous, and perhaps goes a bit far and catches things it wasn't ever intended to catch in order to catch this avoidance that was happening elsewhere in the country. And I think Neil would probably like to say a few words now about that.
Yeah, so anyone that heard the last 2 weeks will know I'm not a fan of this legislation. It's actually my least favourite legislation ever written. It's a belter. I think giving inspectors the subjective powers to determine whether something should qualify or not is dangerous, because you just can't then rely on the legislation. But that's my opinion. Nick is right. The majority of companies that we see are okay with the risk to capital condition. The majority of companies invested in Scotland are okay. We don't see dubious film schemes that were seen in the noughties or into the early teens. We don't see dubious pub schemes that were frankly just property development businesses. We see proper businesses. But that doesn't mean that we don't see HMRC challenges on this. And if I go back a couple of slides, what we're seeing is inspectors are incredibly bullish at the advanced assurance stage. But this hasn't been tested in court. Advanced assurance is asking someone for an opinion, and if they don't like it, they will say, "You've asked us for an opinion. Our opinion's no." Okay then. But you should feel free to seek investment if you wish, and your investors can stick it in EIS1 and then we'll consider it properly. Well, they know as well as you, and as well as me, that without advance assurance on a 50-50 case, most investments aren't going to happen. These are the factors that they state they consider. Increasing numbers of employees or turnover. Fair enough, developing growth. And at least it's increasing numbers of employees or turnover, not employees and turnover, because that would require you to continue to have to hire. or if your turnover slumped, you'd be disqualified. The point is, are you building a business that you intend to grow and grow and grow? And I kind of accept that. But there are industries that it's the modus operandi of the industry not to increase the numbers of employees, but only increase the turnover. And sometimes getting them to understand that actually it's an OR test is easier said than done. Sources of income, what they're looking for here is they would like the company to have the ability to trade with as many people, companies, whatever, as possible. Not one or two, and going to continue to be one or two. Again, I kind of accept that. Assets. Now we're getting into it. Now, assets is there with things like the pub schemes. The pub schemes were, we will go and find derelict pubs, we will buy them, we will do them up, we'll operate them for a minimum period, and then we will sell them. That was straight up and down a property development play. So what they're looking for in assets is an investment underpinned by assets that de-risk the investor's investment. If the answer is yes, we might not like it. But there are lots of companies that require to be asset heavy, and those assets have value to undertake the trade. So that's a dangerous test, in my opinion. Ownership structure. I talked last week about preferential rights on shares, about the fact that you can have 99.9999% going to one share class as long as the other share class gets 0.001%. I was in a meeting with the Revenue and the Treasury a couple of years ago before this legislation was introduced, and someone asked, what about that? If you're attacking ownership structures that are designed to protect against risk, what about that? And there was kind of universal smirks along the panel. They very clearly discussed this before, and they said, we understand exactly what you're talking about. Our position on the shares requirement is unchanged. However, where the shares requirement is being pushed to its limit, with, for example, 99% to one class and 1% to another class, we will look much closer at the other risk factors and see if, in total, we have an issue with them. That was their position at the time, and that's how we divided those things. We saw a case about 3-4 months ago that met those conditions. It was absolutely a high-risk business, no question. Wasn't asset rich, was not. But they rejected it. They rejected the advance assurance on the basis that it was 99.99 and 0.01 in the share classes, because the IM stated that you, the investors, will get 1 times your money back first. And when we put it to them, well, that's crazy. Everybody understands the sole reason for the 99.99 and 0.01 is to protect against the risk of loss of investment. And the only reason you're disqualifying this is because it said it in an IM. It's just fundamentally wrong. But it happens at advance assurance. Therefore, the company's investors had to take one on the chin and invest in others. Subcontracting, they accept that there are companies that do subcontracting, but if subcontracting is undertaken to a large extent, is it really the company that's developing? That's their position. Again, there are industries, film and TV and media in general, being one where it's very, very common to have a small core of individuals in a business and then subcontract out various functions. And frankly, that helps the business develop and grow, because otherwise you'll need to hire 30 people. Marketing the investment opportunity, as Nick said, please don't allow investee companies to put, we will get an exit in 3 years on an IM. Everybody should understand that aspirational exits are where we're all headed, but we will get you an exit. That's the ballgame. And well, we looked at a case where the IM said, in 4 years we will sell this business to XYZ large investee companies that we've already had discussions with. Brilliant. Bang to rights. And finally, fragmentation of the trade. We don't see this very often, but there are dubious investee companies where they fragment the trade into various entities. They try and get around the rules, have a disqualified bit over here and a qualified bit over here. The point of putting this in is to allow the inspectors to challenge that. So those are the rules. Some of them, to my mind, are logical, some of them less so. The point is that they're meant to look at these in the round. But we've seen cases that have been decided against for a taxpayer on the basis of one. And they've been patently clear on the other 6 that they're fine. So are they actually looking in the round? I come back to Nick's earlier point. The majority of Scottish investee companies are okay. The majority. And I come back to my earlier point. The majority of Scottish investee companies are knowledge-intensive companies. These are the kind of companies that I'm not sure they're looking so closely at these days. But they are there. It's a subjective test. And subjective tests where the revenue can just decide, no, we don't like it in advance of a transaction, to my mind, is dangerous, and that's why I don't like the route.
And I think what we've seen, Neil, wouldn't it be fair to say that since the risk to capital rules came in, we've seen HMRC send out perhaps a page and a half worth of questions if the advance assurance hasn't been framed properly in the first place. So sometimes we've picked up where other advisors have maybe left off because they've got a page and a half of questions back from HMRC around these sorts of points that Neil's just had on the slides around risk to capital. So it's given HMRC inspectors a much larger chance to ask questions and to put the company and its advisors under pressure at quite an early stage. And once you've got their heckles up and you've got it wrong the first time, it's that much harder to talk them down when they come to us when something has gone wrong. Yeah,
you're absolutely right. Really, your advance assurance letter is your best chance to get this through, not your second or third bite of the cherry when they've asked questions. Because once they've got the bit between their teeth, yeah, you're struggling. You're really struggling to get them to change their mind on a subjective position that they have adopted. So there we go. We've gone through an introduction to EIS. We've gone through intermediate issues, and today some advanced issues. Some absolute belters. This stuff does come up all the time. I mean, all the time. We look at risk to capital on every single application we submit. We deal with HMRC and risk to capital probably once a month. Convertible loan notes and receipts of value, I probably advise on once a month. Age of company requirement probably comes up once a week. These points come up all the time. And I hope that having gone through this for the last 50 minutes provides you with some information and some knowledge, and that you know where to turn to for more help. I come back to what I said at the start of the very first session, which is LINC Scotland pay us to provide an EIS help desk to you. We've dealt with over 1,000 investments as a result of that help desk plus our own clients, and so in the majority of cases we've seen before, we can help and we can help quickly. Please use it. It's a resource. Your members are LINC. This is a resource that's open to you. We've got 5 minutes to go till 11. I'll take any further questions if you have them.
There's nothing in the chat box yet. Shall I ask you one, Neil, while people keep thinking of their own?
Go ahead.
Okay. What changes do you see in the next 6 months or so with Brexit, and perhaps also with budget changes that might impact on EIS?
I see. I don't see much happening in the budget. I think it may. Well, that's not true. I think it all depends what happens in the next 3 weeks with Brexit. The 2015 changes were brought about because Europe demanded changes be made to EIS if it were going to reapprove it. And there were 6 changes made. One was great. The other 5 were tough. And there were definitely changes in there that the Treasury didn't want to make. I can see that the Treasury, if it is able to, which I guess depends on how hard the Brexit is, I can see a bunch of changes being repeated. The 2018 changes, the risk to capital condition, that was all about the Treasury. That was about the Treasury and the revenue deciding, we need more power. So that's not going to move. That might even get tougher. But I can see the 15 changes potentially getting repeated, or at least some of them, and that would include, for example, the age of company requirement. One more question has come through in regard to convertible loan notes. Does this qualify the investor who gave the convertible loan note, or the company, or all investors in the EIS? It's a receipt of value event. All receipts of value events are limited to the individual, with the exception of the repurchase of somebody else's shares, and that spreads across everyone. It does not disqualify the company. It does not disqualify anyone else. It is the individual who made the loan note or made the loan note subscription. It is their issue and their issue alone. We have 2 minutes left. I can take one more question if you wish. In case someone's typing and we're all sitting here quietly, you all know where we are. And as I say, you've got the link help desk. If there are any questions that come out of this, anything that we've said over the last 2 weeks or today that makes you go, oh, anything at all, please reach out and we'll deal with you with full confidentiality, as we always would, on your particular scenario. Also, if anyone thinks later, oh, I should ask that question, please just fire it on. And if it's the kind of question I think that it would be helpful for other people to know what's been posed and what the answer is, then we'll share it. And I guess my final comment is, as Stuart said at the start, these 3 sessions have been recorded. You're all, I believe, being given logins to view them again if you wish, or skip through to the bits that you want to see.
And Neil, there is a final question. Can you play all those instruments in the background? Somebody has asked.
I play the saxophone, my son the cello, my daughter the violin. My desk actually is a piano, which we all play, and there's another piano to my left, and there's a guitar as well.
Got a theme going on there with musical instruments, yeah.
Okay, so thank you very much indeed for your attendance over the last couple of weeks. We really appreciate it. We hope you found this helpful. We've enjoyed doing it, and we look forward to speaking with you all shortly. Thanks very much.